Let's talk about hedge funds. You're the expert. You probably know tons about this. Cryptocurrency hedge funds, actually. How much do you think hedge funds affect the cryptocurrency markets in 2022?
So there are two types of hedge funds operating in this market. Crypto hedge funds, pure crypto hedge funds, of which there's only a few big ones. I know because I've just started a crypto fund of hedge funds. So I invest for investors in a kind of broad portfolio of crypto hedge funds. So that space, there's about $6 to $7 billion only. It's still so small considering the hedge fund space overall is like 3 trillion. So it's really small. So they don't influence markets that much. Then there's the traditional hedge funds who've started moving into the space, and they tend to be more flighty in how they approach it. So you may be a portfolio manager who can trade currencies and bonds and also crypto. So you manage that volatility like we talked about before. You know, if you have to reduce risk, you'll end up selling your crypto. So there's a bit of that change of dynamic, but there's a lot of big hedge funds who are also setting up entire crypto units. The thing is there's not enough money in the secondary market, i.e. in these trading vehicles like hedge funds, to affect price because the space is moving so fast. There's so many tokens. There's so much complexity to DeFi. There's now NFTs on top of it. There's basically endless alpha. So those guys won't arbitrage away the prices. It can change how the markets trade a bit because they'll hedge with futures contracts. They'll do other stuff, but they're not big enough to drive these markets. So it's still really interesting. They're still just a participant like the rest of us. And it's same with the institutions. Yes, sure, you might see a big buy order because somebody's started putting it on their balance sheet or put it into their fund. But generally, it's not the same as financial markets where investment banks, asset management firms, hedge funds can truly influence price. I think if it is in crypto, it's still whales because they kind of know their way around market manipulation in terms of, causing spike lower, spikes higher to force liquidity.
What's a trick or strategy that hedge funds use that you think more people should understand?
Portfolio construction. Just understanding risk, right? Hedge funds don't think this token is going to make me rich. They're going to think, okay, like I talked about before, what's riskier here? How do I want to construct a portfolio so I can be in this for the time horizon I want to be in? So maybe I'm thinking, firstly, I want to be in this space for the next 5 years. So I think that Bitcoin and ETH are the two best bets for that. So I'm going to put that in my 5-year portfolio bucket and don't touch it. Then I want to have this medium-term bucket where I want to get involved in some of the rotations going on, some of the new developments, and maybe I don't know which protocol is going to work. So I want to think about, how do I risk adjust that? Do I have an equally weighted basket that we talked about before? Or do I say, listen, I'm more interested in DeFi. I'm going to put 10% of my portfolio in DeFi, 5% in NFTs, 20% in layer ones, that kind of thing, and then look at your overall risk of the portfolio. People tend to concentrate when they shouldn't do, because they see people like me saying I'm irresponsibly long Bitcoin or ETH, and they think, well, that's the easy way. But that's come from a distillation of all my macro views, 30 years of experience, knowing when is the right time to take the risk. And you can be wrong. So I set it up that I can be wrong and not lose my house. But other people don't do that. So it always feels like, well, I'm never going to make as much money. You will over time. So I think portfolio construction and risk management is what hedge funds just do better. And they also better at reading market sentiment as opposed to being the market sentiment. And the crypto market, everyone's so busy freaking out or emotional. When Bitcoin was hitting new highs, everyone posting every $1,000 up with a new price. It's like, guys, stop this. Hedge funds just don't do that. You have to be less emotional about your money and more thoughtful about what you're trying to achieve.
Clear this next question up for me, because I'm not saying it's my view, but I've seen this on Twitter.
Oh, sorry. Just to go back, one other thing that hedge funds use that retail investors don't use enough of, options. So for example, I had a bet at the end of last year. I thought that the historical comparisons would hold and ETH could have a strong rally. Okay, I own plenty of ETH and I didn't want to take leverage because I don't want to lose it. So I could buy call options. It's a small percentage of my overall portfolio. So if I lose it, fine. If I get it right, I could have made a 40x. And if I lose it, you lose your premium. So, I lost 3-4% of my overall portfolio by taking that bet. I could have made huge. So it made no real difference when ETH moved 4% in a day. So it doesn't really matter. So options give you a defined risk reward. And that's so useful. The hard part is time. You have to get your timing right. Is it going to be the next 3 months, 1 month, whatever? But that's one thing that people don't use, and they don't use options to hedge. I mean, I don't hedge my position, but some people should. So options are something to learn about. Sorry,
Raoul,
I interrupted you.
No, please. Raoul, why don't they teach about options in schools? Finance is such a big part of our lives.
I really don't understand why they don't even teach personal finance, let alone investing. Because the whole game of working is to accumulate capital so you can not work in the future. And so investing falls as part of that. That's retirement. And yes, you get other fulfillments out of working, but they don't teach people that one single thing, which would be super helpful, which is how to think about investing, how to take risk, when you should be taking risk, when you should just be dollar cost averaging and 401k'ing, or when you really think you've got an opportunity and an edge and you want to take advantage of it. But yeah, it's a shame. It's a real shame.
The negative view on Twitter by some people I've seen is that Web3, this revolution, is controlled by VCs and hedge funds. How true is that, if true at all?
Some is, some isn't. I mean, they're the source of capital. Right now, until we change the accredited investor rules, how are you going to do this before somebody gets prosecuted by the SEC for issuing a security? So it's not straightforward. They are the pools of capital. If you want the capital to come into the space, the institutions trust a venture capital firm to allocate that capital accordingly into the ecosystem. So it's very difficult to break that. And I think it's wrong to think of it in those terms. There are some projects that are very decentralized and others that start more centralized, end up less decentralized. It's all okay. And as an investor, you make your choice. Now, there is no one Web3. It's like there's no one Metaverse. It's a new way of trying to interact on the internet and a way of building business and having ownership for the networks you're part of. Now, some of them are going to be decentralized and some are not, and that's okay too.
Final question on hedge funds. And I just have all these because you're the man to talk to, given your background. There's an infamous clip of Jim Cramer back in the day, maybe 2003-05, of him talking about, oh, you'll spread fake news to manipulate the price so you can either buy lower or sell higher. Does that sort of, not illegal, I don't think that's illegal, but does that sort of manipulation in the news go on today in crypto?
Yeah, so it doesn't, in my world of macro, it's almost impossible to do because you're dealing with the treasury bond market or the S&P 500 or the dollar against the euro, right? These are gigantic things. So you can't manipulate those prices for anything more than a few moments. In single stocks, we see it in stuff like GameStop. We see it in the short sellers. We see it in people trying to squeeze each other out. I mean, what was really interesting about the whole GameStop thing was that was basically retail playing the hedge fund game, which is we know there's a bunch of hedge funds who are really short this. So if we all gang together, we can squeeze them out. Hedge funds do that all the time to each other. Less to retail, they actually just do it to each other all the time. Because what you're looking for is the highest risk reward opportunity where you can find a weak link in the chain and exploit it. So it still goes on for sure. It still goes on in a number of different ways. In macro markets, it's almost impossible. In crypto markets, it's more whale driven again. We've seen various narrative shifts. You can see some people who like to move prices around for their own purposes. The hedge funds don't have a voice in crypto right now. I mean, when's the last time you said, "Oh my God, Raoul Pal, he's a great hedge fund manager, but oh my God, Raoul Pal of Blocktower, he's been talking about that." We don't. We talk about what Arthur Hayes just wrote about, or Suzu, or Kobe, or whoever it is, right? So it's actually a different set of players doing it in crypto. Traditional markets, hedge funds do for sure, because they're the ones with all the money.
Yes, great perspective. To watch the full conversation, there's a link down below in the video description. And if you're interested in learning more about cryptocurrency, click subscribe. We drop a video every single day. You do not want to miss one. See you tomorrow.